All right, traders, this is Blake Morrow with ForexAnalytix. And with me right now, I have Chris Weston with Pepperstone Securities. And how you doing, Chris?
Blake, I'm very well. How are you? You well?
I'm doing well. It's the end of a trading day. It's been a really wild couple of days. If you guys have been following the equity markets, we've seen a lot of movement in the S&P. We've had a move to the bottom end of the channel that we've been monitoring around 3,700, back up to about mid-range. A lot of movement in individual stocks and not a big impact in the currency market as of yet. Now, I brought Chris on here for a reason, because he's going to talk a little bit about what we're seeing with the quote unquote reflation trade. But before I do that, I want to mention, if you open a Pepperstone Securities account, if you do not live in the United States, you do not live in Canada, you can open a Pepperstone Securities account just by clicking on our website at the Pepperstone banner up top. And what you can do is you can get ForexAnalytix for free for 2 months if you open a Pepperstone account. And then from there, if you trade more than 500,000 in currency, you can actually get another 2 months of ForexAnalytix for free as well. So it's a real big benefit. But one of the big benefits of using Pepperstone Securities is not only its first class operation that you guys deal with, but you get to deal with Chris Weston. And Chris, you're one of my favorite analysts out there. And so I wanted to ask you, how are you feeling about what has happened over the last couple of days? Because the impact in the currency market has been pretty minimal.
Mate, you're incredibly kind, flattering indeed. But yeah, I think from a cultural, social perspective, the rise of Wall Street bets and the movement that's taking place is it's absolutely fascinating. The idea of targeting stocks with high short interest and being able to cause a short squeeze, and then ultimately market makers to delta hedge, and that perpetuates the move higher. I think I'm all for anyone making money in an innovative way. So I think that's a really interesting scenario. So I'm not totally against that. I am against misalignments and misallocation of capital in financial markets, but then I think that these people do have a very strong case in the idea that the Fed have probably been doing that. You can't short credit because the Fed are on the other side of that. It's very difficult to short fixed income because they're doing QE, and if the yields go too much higher, then they'll probably do yield curve control. So when we talk about manipulation in markets, the Fed are the architects behind that. But there's definitely a mania going through stocks. And I think it's interesting. I actually thought that the SEC would do something more to limit the amount of short interest that would be in certain stocks. I didn't think it would come from the brokers such as Interactive Brokers and Robin Hoods, and actually those guys raising margins and closing out clients. I don't think it would come from those people. But yeah, it's an absolutely fascinating story. Now, the interesting point that you brought up there is that this. I thought this might have gone on for a longer period. We saw a massive de-risking from hedge funds on the back of this, and that resonated across markets. And as that volatility spiked significantly, we saw a bid coming back in the yen and the Aussie dollar, the US dollar. But that's been a one-day affair. The dollar index is down 12 basis points or so, but it's down, and we're seeing the equity market back up. The VIX is down 7 volatilities, and we're seeing the reflation trade back on again after very much a short period of time. So, I thought this might have been a bit more of an issue and taking a bit of more froth out of the equity market, which could have seen the dollar index breaking out. You can see that rate, the sort of test of those recent highs that we can see into sort of 90.88. I thought we might get a break of that, and that could be cause some more more systematic and CTA traders to close out those positions. But It hasn't. It's been a very short-term affair. So it's been a one-day affair. But yeah, we do have this dollar index very much on our watch list, not just because if we do see another bout of risk aversion kicking on, the dollar index is going to break that downtrend that you're drawing quite eloquently there. But also, the other factor is given that 57% of the weighting of the dollar index is from the euro, and you've seen the likes of ECB member not talking down the currency. You've seen the Bloomberg article saying the ECB have got more tools and don't underestimate a rate cut, and they've tried to jawbone this down, which potentially should have propelled the dollar index higher, but it hasn't happened. So I think we've got this on the watch list. I'm not sure how you guys at ForexAnalytix are dealing with this, but yeah, this is one that's on the watch list. We get a break, then I'll take a much more constructive view on the dollar. For now, just seeing to see if price rolls over on this. But yeah, we thought this probably could have been a slightly longer term affair, Blake, but it's been pretty short affair, and we're back to watching reflation again and better times in 2021.
It really has. And with that being said, I mean, the dollar index is, as you can see here on the screen, we are up against some resistance, but in all actuality, we are in a pretty strong downtrend. So I know you got a couple of charts showing more of a really close look at what's happening with yields and the yield curve. And guys, I want to reiterate and go ahead you can go ahead and take the chart if you'd like. I'll stop sharing and you can go ahead and take over from here, Chris. But what I wanted to say for those of you that are listening in, one of the benefits of dealing with Pepperstone Securities and also Chris Weston is that you are going to get educated on a lot of the internals and what's really moving the markets behind the scenes, where, you know, with ForexAnalytix, we're pretty technical driven. We're macro driven. I like to look for good setups along with the rest of our team from a technical point of view, but understanding why a move is developing is really important. And this is one of those things that, you know, I felt that it would be really important for you guys to understand, especially coming off of a very wild week on Wall Street. So, Chris, what are you showing us on your Bloomberg screen right now?
Can you see the break evens and the tips chart there, Blake?
I sure can.
Yeah. So look, for me, I'm going to show you the influence this has on the dollar. Yeah. Prior to what we've been seeing the last couple of days, there'd been this big consensus trade that probably once we get past March into April and then beyond, we're going to get this next bout of fiscal stimulus being agreed upon, another $1 trillion or 5% of GDP in the US being agreed upon, going through the Senate. You know, potentially another $1,200 in stimulus checks going through and various other factors. And that's going to hit the market. So this period of uncertainty should get reconciled and it should pass through the Senate. So for April, and that's going to hit the market at a time when the vaccine rollout is going to become more efficient. The pent-up demand, specifically in the service sector, is going to kick in, and you know, we've been buying goods, but then it's going to impact services, and we know that US GDP is 70% service-driven. And then you've got base effects kicking in as well, and you know, you've got a very, very poor inflation number that started in April, and so therefore we are going to see CPI moving above 2%. We are going to see core PCE moving above 2% because of base effects. Whether that's sustained is something that's going to happen. The other thing that we need to think about then is the velocity of money. Velocity of money has been falling. The banks are holding money. You know, the rate of a dollar changing hands and turning over has been falling. But because of base effects, again, that's going to start moving higher, and that's really genuinely inflationary. So I do sit in the inflation camp. And if you have a look at the blue line here, this is the market's anticipation of inflation. A lot of people look at this as this kind of guide to inflation expectations. Yeah. And the Fed look at this very closely. They look at actually about 24 different indicators ranging from the University of Michigan 5-year inflation expectations. There's 24. You can go to the website and you can see 24 different ones. But the one that the market's put a lot of weight on, and why you've been buying copper, why you've been buying the Aussie dollar, why you've been steeper curves and playing this better growth, why you've been buying financials, why you've been buying cyclical stocks. It's all one trade. And right at the heart of that for me has been these two assets here that you can see. So you've got Treasury inflation protected securities. These are fixed income instruments where the coupon or the sort of the dividend effectively for these will move up and down depending on the level of inflation. And you can see here that they've been moving lower. It doesn't surprise me that the Fed are the biggest buyers there, but you can also see that generic US Treasuries here have been moving up a little bit. They've been grinding higher. You can see they're trading at 104 at the moment. But the difference between these two, effectively, is the break-even inflation rate. Okay, so we've got one at 104, and you've got one at negative 106. Now, the difference between the two is the expected inflation average over 10 years. And you can see it's at 2.1%. So the market is saying that over the next 10 years, we are going to see inflation, CPI, average 2.1%. You can see it's been creeping up. So inflation expectations have been moving higher. And inflation expectations generally breed inflation. They have this manifest that does come into actually higher inflation. So this is a really positive situation. This is what we've used as our guide. The difference between just generic US Treasuries and TIPS, both tradable products, but the difference between these is what the market looks at as inflation. Now, the interesting thing here is that if this was to get up to 2.25%, that would be saying that the Fed have achieved their mandate. The market is saying that they need to see inflation sustainably above 2% for a period of time. So that is the market then. Why do I say that? Because the Fed look at core PCE, okay, and core PCE generally trades about 30 basis points lower than CPI, or Consumer Price Index.
Got it.
The break-even level matches or measures or tries to mirror the CPI number. So if we get to 2.25% or 2.3%, it would be basically saying that core PCE, which of course the Fed are targeting, would be above 2%.
Very good. And so,
okay,
yes, thank you.
So let me bring this chart in and just show you why we look at these real yields. This yellow line. Okay, so what we're looking at here is this real yield. So this is inflation adjusted bond yields, this white line, or what we call TIPS. And as inflation expectations have been moving higher relative to US Treasury yields, the real yield has been moving lower. And you can see the dollar index, this purple line here, has just really, if we go in really since March of last year, the dollar index has had a reasonably strong correlation with that. I mean, there's periods where it sort of breaks down a little bit, but recently, if real yields or inflation adjusted yields are falling, the dollar index is certainly going along for the ride. And I put gold there as well. The gold's breaking down. So that's why we look at that, Blake. I mean, for me, we need to take a view on what's going to happen with inflation.
Yep.
Expectations, and we need to have a view of what's happening with Treasury markets. If inflation expectations continue to pull away from Treasury yields, then the dollar's going to fall, and vice versa. If we get to a point where real yields start moving higher, then the dollar's going to rally, and this reflation trade's going to come unwound. We're going to sell the Aussie, we're going to sell copper, and all those factors. So this is why we look at the bond market very, very closely.
Now, and I'm going to ask you this one last question. I know you want to show the traders your volatility schematics there, but is it possible that we start to see inflation expectations rise, yet we see stocks come down because people start to anticipate the Fed going to be a little bit more aggressive in their rhetoric and quite possibly adjustment of bond purchases? And could that be the catalyst that drives us into some sort of risk off scenario?
Yeah, so my theory on this, and this is the macro framework which I work in and I trade in and out of this, is that the market's okay and happy to continue to bid up risk as long as this blue line is moving up concurrently with treasuries. If they're both moving up, but this white line, the treasuries, is moving up at a faster pace, and therefore the real yield moves higher, which is a negative. But as long as they're both moving up because of positive factors, the world see reopenings and pent-up demand kicking in, then I think people will just rotate and continue to buy financials, and you're probably likely to see the Aussie's doing quite well, and there's not going to be huge amounts of volatility in FX markets, or that volatility is not going to pick up too much. The scenario for me, which is probably something that happens in March, is if we hit this blue line hits a situation where we get up to say 2.25, 2.3%, and then it's capped out because the market is saying we're not going to go any higher. The Fed's achieved their mandate, and people are just not going to push break-even levels higher, inflation expectations any higher, because we've capped out to that level. But what happens then is the Fed, because now we know that the Fed are purely reactive. We know that they are an evidence-based mechanism. We saw that yesterday in the Fed meeting. They want to see the whites of inflation high. They actually want to see evidence coming in. And I think from around April, they're going to change their tune. They're going to actually say that we're starting to see things. Their rhetoric is going to change. And if generic Treasury yields that you can see on any platform, like TradingView, you've got them, and that starts accelerating, but the blue line's capped, then real yields are going to move higher, and they're going to move higher quite aggressively. And the Fed are either going to do two things. They're going to allow it to happen, in which case I think you're going to see higher volatility in FX markets. I think the dollar probably rallies in that environment. Or, and this is where it gets interesting, they say we're not going to allow the back end of the Treasury curve to sell off and move higher too much. And that's when we start hearing more words about yield curve control.
Yep.
And that's when the dollar gets smashed. The balance sheet, we start talking about, 11 trillion and all this sort of stuff. The dollar gets smashed and gold gets absolutely bid up in the big way. So that's why we look at this very closely, because when the Fed see evidence, we know they're reactive. They used to be proactive. They're now purely reactive. Once they see evidence at which the market's already pricing in, then I think if break-even levels get capped at 225 and treasuries continue to sell off as the Fed change their tune, you could see real yields moving higher, which is going to be a dollar positive, gold negative, and probably may see some volatility in equities as well. But then the Fed need to make a decision. Do we allow this steepening curve and 10-year to continue to move up to, say, 1.5%, 1.75%? Or do we cap this move because it's going to have an impact on funding for the Treasury and the budget there? If they cap the move for yield curve control, that's when we see the dollar getting absolutely taken to the cleaners. I think people will be selling dollars and people will be buying Bitcoin and all the hedges against balance sheet expansion and all those factors. So that's why I think this is really interesting. I think this March to April period is going to be absolutely fascinating. If the world continues to improve, the vaccine rollout goes out, the pent-out demand continues to go the way that most people anticipate. Americans come out, start spending more aggressively in the service space. Big if, of course, velocity of money changes because of base effects, and break-evens are capped at 225. We're going to be in a situation where the Fed are either going to allow the back end to continue to steepen, which is going to be dollar positive in a big way, and those dollar shorts, but are going to be quite concerned, or we're going to see yield curve control or some sort of increase of QE to stop the grind high. And that's where it becomes really interesting.
Yeah. And you know what, Chris, that for me and for everybody listening in at home, especially if you're listening to it over the last, relatively over the last couple of days that we've been trading, and this is a fresh and new video for you, and you're watching it as it's being released. There's a lot of actionable ideas in what you just said. Now, before you show everybody your trading schematic, I wanted to just reiterate, guys, in order to get Chris's analysis on a daily basis, you can follow him on Twitter, which that's how him and I originally met, even though we're on both sides of on two sides of the world on opposite ends. But also as a Pepperstone and ForexAnalytix client, you're going to receive Chris's analysis quite frequently. So, Chris, show us that schematic that you had on the volatility.
Okay. Yeah, I mean, I think I just looked to. I've got a fairly unique way of measuring risk, and I know you guys look at risk as a big factor as well. But for me, one of the big things is we put out a lot of once a week, put out these various charts. But for me, I was talking to a client the other day. He said that he traded quite poorly, runs an expert advisor, runs a systematic strategy. And traded February, March quite poorly because the volatility was too high. And I said to him, well, you're running a systematic, you're running an algo. Have you got like a volatility component to it? That adjusts, how much risk you're taking on based on the movement in the market, and then adjusts your position size accordingly. And he said he didn't. And I said, well, that's your problem. And for me, the idea of managing risk is absolutely essential. It is what we do, isn't it? It's what we do as traders. We're looking ahead at the event risk over the next 24 hours and say, do we want to hold positions? But also when we're placing the trade, how much risk do I need to take on in my stop loss? And the more risk I take on, has big implications for my position sizing. So, everyone uses things like average true range, which is using, price moves that have happened. And yeah, of course, people are looking forward, and there's an element of forward-looking component in that. And people will use things like pivot points to an extent, Fibonacci retracements, blah blah. But yeah, there's a whole ton of things you can use to measure movement in the market and guide your stop loss. One that I like to use is implied volatility. So I'm using options pricing. These are numbers here. You can see them. These are overnight implied options. So what that's effectively saying, if you take Aussie dollar, for example, is it's using overnight option volatility from the aggregation of market makers that are fed into the Bloomberg terminal. And they're saying that using overnight options, that Aussie dollar on an annualized basis is going to move up or down 8%. That's effectively what it's going to say. Now, I want to work out what a daily move is from the annualized number. So the implied volatility is a key component for pricing options. But it's the expected movement over the next 24 hours, effectively, is the simplistic way to do that. And the market's saying on an annualized basis, we're implying that the Aussie dollar is going to rally or sell off 8%. So what I do is I divide that number by 15.9. And the reason I do that is because there's 252 trading days in a year. And volatility effectively is the square root of time. So effectively, we're just taking the square root of 252. And that's 15.9. So people out there who are trading the VIX, for example, just get the VIX and divide it by 15.9, and you can see what the daily implied move in the S&P is over the average to expected to average, which is around 1.8% at the moment. And you can use that for your equity trading as well if you use that. But so what we've got is we've got an implied move now in the Aussie dollar based on that of 39 points. And now I just project that level to the current spot price up or down, and that will therefore guide me to how much risk I need to take on. So I'll probably leave my stop loss slightly further than 39 points away. But what it does is it uses what the market expects in terms of movement rather than what I expect of movement. And that will look at all the event risk that's coming out over the 24 hours, and that will project a level. And it also gives me a level of confidence because it's a standard deviation number. So that number can fluctuate. You can see at 8%, the different, the low's been 4.38, the high's been 68. So it's pretty low in Aussie dollar. It's the 5th percentile of the 12-month range. But ultimately, I've got now definition of what the market expects in terms of movement, and I can use that to guide my stop. And then if I understand that's quite a tight stop, it means I can increase my position size. Whereas if there's a big event that's coming up, might be a Fed meeting or a Aussie jobs number, and that number's closer towards, say, 60 or 70 points, I know that my stop loss on my trade, because I trade off 4-hour and daily charts, has to be slightly wider, which means I need to take my position size down. So this helps me guide my risk. It helps me guide my stop loss. There's a number of other charts I do there, but I think it's really essential for people when they're placing their trades to be dynamic and have a system that looks at the movement in the market, and that will dictate how much risk you're taking on, and then of course your position size as well is accordingly to that.
And that's extremely important information as a trader. And as a trader, when I look to enter the market, understanding what that volatility might be is really going to drive my position size. And that's why people that know me and they trade with me and they have traded with me for years, they know that if I'm trading like a Euro cross, especially against the Aussie or the Kiwi, my position size might be 1/3 of what I would normally even trade on a Euro dollar trade. And even though we all have different risk parameters, and you could have somebody trading a $5,000 US dollar account and somebody trading a $500,000 US dollar account. Obviously, trade size is going to be different, but still, in relationship to volatility, you're still going to be taking a proportionately same size trade. So that's why I always try to explain to people that it really doesn't matter what we're doing, but our risk and the size of position is really going to count based on how much we're trading, and it's going to differ from me to you to the next person that's trading the market. So Chris, how often do you get this information out to your traders?
Well, we've got a Telegram channel which we try and post this every day, because I think this is really important. It gives you a sense of what the market's expecting on the day. So if you've got a big event risk, for example, it's nice to see if the market sees that as a volatility event. I think there's a lot of retail traders who struggle to price risk around events. So I look at whether the market's expecting a Fed meeting or a jobs number to be a volatility event, and to what sort of extent the move could be. So we try and post it on that every day. I post this quite regularly on my own Twitter channel, and then I put out a daily note called the Daily Fix, which we'll put out a couple of times a week. So look, I think it's just important to know what's expected in terms of movement, and we can adjust our risk to that. But I think as well, going back to sort of the big thing is when do we get volatility in the FX market? At the moment, it's a sleepy hollow. All the volatility, Blake, is in single stocks. It's in equity markets. Gold's pretty chilled at the moment. And my view is that it's coming. And for us as FX traders, we will see better times ahead, and we need to prepare ourselves for that. But it's going to come in that window, March to April. And from then, when the Fed start seeing the whites of inflation's eyes, they're reactive, they start to change their language. We start to see the market question what happens with the bond market. And so I look at bond market volatility. As soon as bond market volatility starts to move up, that's going to be my cue to tell clients, now we're going to start expecting to see much higher FX volatility. At the moment, it's pretty quiet because the Fed are very dovish. Central banks are at war with each other. They're all trying to outdo each other. The ECB very much, the latest out there. But once we start seeing that inflation kick up, rates volatility is going to go up, and FX volatility is going to go up. And that's going to change the game for a lot of us FX traders.
And you know what? With that being said, I want to say that this is the perfect time to be trading the currency market. It is the perfect time to be opening your account with Pepperstone Securities and also becoming a ForexAnalytix subscriber. Chris Weston, I want to say thank you for your time. I know it's early in the morning for you, and for me, it's getting late in the evening, but this is when the two ships will pass for us.
It will, mate. Yeah, absolutely.
Yeah,
it's always a pleasure to speak to you, Blake. And I hopefully do a few more of these going forward. I'm sure we will.
Absolutely. So thank you so much for your time. And guys and gals, we'll be talking to you soon. I'm Blake Morrow. That was Chris Weston with Pepperstone Securities. Have a great day.
Thanks, guys.